Dear clients, welcome to Phillip Security Research Relay Market Update. I'm Travis. For this week, I would like to provide our supportive viewers an update on the real estate investment trust, in short known as REITs sector. I will start by giving you a short brief update on S-REIT performance in 2012, followed by the potential upside for REIT in 2013, and wrap up with our preference among the S-REIT universe. S-REIT has performed remarkably well, and you and eye-popping price returns of 37%, outperforming the benchmark STI index 20% in 2012. Including the dividend, the total return sum up to 46% for S-REIT. In November and December, STI index had returned higher price gains than the S-REIT. Not surprising in our view, as S-REIT has reached lofty valuations. This is further affirmed by having more S-REIT trading at a premium to its net asset value per share. At this juncture, both healthcare REITs, namely Parkway Life REITs and First REIT, are trading at higher NAV premium than the rest. This has shown that the investors are willing to pay a premium for the earning resilience and defensiveness of healthcare REITs. Within the 23 REITs, 14 of them have outperformed the FTSE REITs index. The top 3 performing REITs sorted by highest total returns are Fraser Commercial Trust 90%, Fortune REIT 80%, and AMP Capital 72%. Following such a strong run-up in 2012, I believe most investors will be keen to know whether S-REIT still have the impetus to grind higher ground in 2013. Therefore, we have gone back to our drawing board to relook at S-REIT potential. First, take a look at the price-to-book chart. At present, S-REIT price-to-book ratios of 1.13 is trending around positive 2 standard deviation above the mean level of 0.96. Certainly, the positive standard deviation is likely to serve as a strong resistance for S-REIT to march to a higher level. From our viewpoint, it's going to be an uphill struggle to break above the 2 standard deviation. However, we are expecting revaluation gains across the board, as many of the REITs will be recognizing revaluation gains in the 4th quarter of 2012. By and large, there could be a re-rating catalyst for S-REIT when the revaluation surplus is accounted for. From a yield spread perspective, it's not difficult to identify that forward S-REIT dividend yield and 10-year bond yield has since widened apart during the Eurozone meltdown in August 2011. Fast forward to January 2012, it seems to be the turning point for S-REIT, as the yield has started to tighten and accelerate in June, but took a breather in November and continued to compress further in December. For the year 2012, the yield spread had compressed by approximately 130 basis points and translated to a price returns of 37%. The tightening trend has a high propensity to retrace back to the yield spread level prior to August 2011, which suggests another 30 basis point to go based on our estimations. This could mean there may be at least 8% price return for S-REIT in 2013. A point to note is that the rate of yield compression is expected to slow down in 2013. Apart from the tightening of a yield spread, I believe some investors will agree with me that dividend returns provide some form of certainty of what investor needs against a backdrop of low interest rate and high inflation environment relative to the stock price appreciation given the expected slow growth in Singapore economy ahead. The strengthening of Sing dollar may have investors to include high-yielding stocks like S-REIT in their watch list. We cannot accentuate any further that investors have to be selective in REIT picking, as they are no longer cheap anymore. Having said that, S-REIT may offer at least 8% price return this year. Investors may look forward to a double-digit return including the dividend. Akin to our previous preference, investors may consider REITs like Parkway Life REIT, First REIT, and Ascenders REIT with part of their lease structures pegged to CPI, which will benefit from the elevated inflation rate. Industrial REITs will continue to enjoy positive rental reversion from new leases and renewal, as well as through acquisitions. Risk takers may go for higher yielding industrial REITs such as Sabana REIT, AMP Capital, and Cambridge Industrial Trust. With that, I will end here. Thank you for watching, and tune in next week to Phillip Security Research Relay Market Watch.